I got green all over the place, Charles. All major averages in the green right now. We're grinding higher. That makes sense to you, Charles, or no? Do you think we're being kind of complacent? Plenty of questions, of course, still out there, right? I mean, trade and tariffs. I just had a smart economist on the show, Charles, told me there's a 50% chance we're going to trip into a recession. So what do you make of these market moves?
Well, I think he's being conservative to say it's only a 50% chance of a recession. But yeah, this is a very complacent market. We went into this year with the market priced for absolute perfection. Of course, we didn't get perfection when we ended up with a trade war, a lot of volatility in the administration, and of course, the Middle East war. All of that had the effect of knocking stock prices down for a bit. But now we're right back where we were in February, touching new all-time highs here. That's a very aggressive market. You have the S&P priced at about 28 times earnings, which is a very expensive valuation under even the rosiest scenario. And measured by sales, it's trading at about 3 times sales, which puts it at one of the most expensive markets in history. So yeah, there's a lot of optimism built into this market. Is it too much? I guess we'll find out soon enough. But yeah, investors are they're pricing in really good things coming in the rest of the year.
And so, Charles, the valuation's maybe looking a bit stretched according to some metrics. You don't see us growing into that. What do you see for corporate profit growth with earnings season, Q2 earnings season coming up?
That's going to be really tough because the environment we're in right now, post-tariff, makes comps really, really difficult. So will earnings growth even be higher at all this year in a lot of sectors? I really don't know. Like that is really... That remains to be seen. But going forward, the 28 times earnings is of course at trailing earnings. The metric does get a little bit better if you're assuming pretty robust earnings growth. I'm not so sure that's a realistic expectation though.
So Charles, so you sound cautious here. Against that backdrop, where do you want to be committing capital, Charles? How do you want to be positioned?
Yeah, in a market like this, it probably doesn't make sense to put a lot of buy and hold capital at play. So you can really go about this 2 ways. You can focus more on short-term trades, or you can focus more on income. And I think right now, with some of the yields we see in certain pockets of the market, taking an income approach makes a lot of sense. Business development companies are a fine example there. A lot of these are yielding in excess of 10%. Some of the more conservative ones are yielding 5 to 7. That's really competitive if you believe, as I do, that we're likely to be in a range-bound market for probably the rest of this year.
When you talk about these business development companies, these BDCs, Charles, which ones make your radar?
Given the economic uncertainty, I think you do want to focus on the conservative names right now. I don't think you want to stretch and go for the super high yielders. Main Street Capital is probably the highest quality blue chip in the group. They have a very conservative dividend policy, which I like. They pay what I would call a sustainable monthly dividend. And then as earnings allow, they top that up with special dividends. So if you look at just their kind of conservative monthly regular dividend, it's yielding about 5. You add in the special dividends they've had over the last year, that pushes that yield to about 7. Now that the special dividends vary, of course. But a 5 to 7% yield with a very good possibility of that dividend rising over the next year and then every year beyond that is attractive. This is a company that has managed to maintain or raise its dividend through every economic setback we've had since 2008. That's attractive.
Charles, appreciate your time and those picks. Thank you, sir.